Okay guys, so welcome to this video having a look at the US dollar against the Canadian dollar. Now this is a trade update because I did post two previous videos calling for this to be a strong sell in the markets as oil prices are rising in the market, supporting the Canadian dollar, which is a commodity currency because Canada's main exports is crude oil, which makes up a total of 20% of its exports. So it's very important to the country's export market, the US being Canada's main trading partner, purchasing 72.8% of all of Canadian exports. And we have lower interest rates in the United States going against the US dollar across the markets. We're seeing dollar weakness everywhere we look in the currency market. So let's just remember, with oil being Canada's main export, we're now seeing oil prices rallying off the lows of the year as production cuts by OPEC and the rollout of a vaccine is very positive for oil because demand for oil will increase as aviation, travel, people get back on the road, people go back to work, and oil is a main component of the global economy. And that increase in sales of Canadian oil exports will mean the currency will be in a higher demand. There'll be more dollars coming into Canada to pay for those oil exports. The money's going out of Canada to pay for the imports, and that means there's going to be a positive balance in the country's current account balance compared to the United States negative balance. And remember, when you're looking at one country's currency valued against another country's currency, what makes a currency pair value go up or down is the rest of world currency reserves for a country. So if the US is an importer of goods and services, so the US pays for more goods to come into their country than they sell to the rest of the world, so more dollars are going out into the rest of the world than dollars are coming in. And then when you compare rest of world US dollar reserves against the Canadian dollars rest of world reserves, and you compare them as a ratio, that's how you get an exchange rate, which is why the commodity currencies are doing very, very well against the US dollar at the moment, because commodity prices are rising, because oil demand is increasing, thanks mainly to China, which is the world's biggest oil consumer, and the Asian region, which is recovering at a faster pace than the rest of the world. And oil consumption is picking up whilst OPEC are cutting production cuts. Now, most importantly, we have to understand that when we look at the US economy, we just have to remember that when you're looking at Canada, you can clearly see there is a positive current account balance because they're exporting 431 billion to the rest of the world and they're importing 369 billion. So there's a positive flow of money coming into Canada, whereas with the United States, a complete different situation because the US has a huge current account deficit because they're importing a larger majority of goods into the US and they're exporting. So they're exporting 1.4 trillion, but they're importing 2.4 trillion. So they're literally importing double what they export. So there's lots of US dollars going into the rest of the world. And then you get a situation where there's low interest rates in the United States. So investors are not buying government bonds. They're not buying the currency to earn a profit overnight because of the relative interest rates between, say, the US and Canada. And that's why when I take you over to the spreadsheet, you can see the interest rate differential between Canada and the US really does drive the currency pair in the market. So here we have the difference in interest rates between the United States and Canada. And then here we have the US dollar, Canadian dollar exchange rate. So what you can see is when it's positive, this means the US interest rate is higher than Canada. And when it's negative, that means the US interest rate is lower than the Canadian interest rate. And you can clearly see the exchange rate closely follows the interest rate differential. So the US did have a stronger interest rate than Canada previously, and the Canadian dollar, US dollar had been around 140 before interest rate cuts were implemented. And then once interest rate cuts have been implemented, and now the US doesn't have a positive interest rate differential, the US dollar and Canadian dollar exchange rate has been on a downtrend. So at the moment, it doesn't make sense to buy the US dollar against the Canadian dollar because you're losing money overnight because of the interest rate differential between the two. So at the moment, it's not an attractive trade when you're trading this currency pair. Because just remember, when you're buying the US dollar against the Canadian dollar, you have to first own Canadian dollars. You sell your Canadian dollars in exchange to buy US dollars. You're paying interest on the Canadian dollars that you've borrowed, and you're receiving interest on the US dollars that you've purchased. And the difference between the two will either mean every single day when you hold this trade overnight, you're getting paid the difference in interest, or you're paying out the difference in interest. And right now, you're paying out more money than you're receiving on the dollars that you purchase when you purchase a US dollar. So it's attractive to sell this exchange rate. So we understand the fundamentals. We got higher oil prices. We got negative interest rate differential when you're buying the US dollar against the Canadian dollar. And on the flip side, you have the US importing more goods into their country than they're exporting. So there's more dollars going into the rest of the world. And when you're comparing these dollars, US dollars against Canadian dollar, rest of world currency reserves, then the US dollar continues to get weaker on this fundamental basis. So we're looking on a technical level now. We have a downward trending channel clearly defined within this range. We're making lower lows and lower highs. And I've posted the 2 videos previously showing you this trend in play before I had further downside movements as we're seeing now. But we're coming to 127, which is a key support level. If I show you 127, you can clearly see here, there's been a support area. It's been a resistance area in the past. We've seen a lot of price action around this area here. Again, it's been a support area going back to 1994. So you can see this area has been used for a very long time in the markets. We've had support, we've had resistance, we've had resistance around this area again, more resistance again, then it breaks through, then it comes back down and it bounces off this area again. So a lot of price action around this area historically. So what I'm trying to say is that if we get a firm break below this level again, this indicates a trend is firmly in play, and this could be a short sell opportunity to get in once we get a firm break below 127. What you'd want to do is have a 1 month volatility stop loss to make sure that the currency pair fluctuates by how much it usually does before you get stopped out if the trade is wrong. So you'd want to run a 3% stop loss, because that's on average how much the currency pair moves by on a monthly basis. You can see the moves here on the pullbacks. That's literally how much the currency pair fluctuates by on a month-by-month basis historically. So that's how you'd want to have your stop loss once you get a break below 127. Or you could wait, maybe there'll be another retracement back to the trend line again and get a further bounce off the trend line to the downside. That could be another opportunity to sell on the next retest. And in that case, you'd wait for the bounce and price action to start to move to the downside. And then we could enter a position here and have our stop loss again at around a 3% 1 month volatility analysis. So that's a good trade idea we have at the moment for the USD CAD. Lower interest rates in the United States, higher oil prices, and negative current account balance in the US relative to Canada's positive current account balance. And we have the recipe for a good short sell in this currency pair. So I hope that makes sense. But here's an update for the USD CAD. Thank you.